Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee futures. So in September, October and November, a few bullish patterns started to emerge. These were weekly key reversals up in mid-September, mid-October, the turn of October into November, and in mid-November. Their constant attrition between them stopped the decline and eventually turned the market back up. The mid-September action eventually became a pattern, an ascending scallop pattern. That led to another pattern, an early October to mid-November bullish halfway hesitation, which in turn led to the late October to date imperfect, breached and possibly broken bull channel. And that's currently 173.30 to 187.85. And it's highlighted in dark blue on my daily chart. I say imperfect as we have seen two separate penetrations topside 3 weeks ago and again last week, and arguably this week as well. The previous breaches had been repaired. I suspect the reason for the attempts higher was because of the crossover 2 weeks ago of the upper bull channel line with the significant neckline, currently at 182.65, of the large January 2020 to April 2021 reverse head and shoulders bottom that is highlighted in green on my daily chart. Some people back then may have thought it would be an ideal way to punch up through two resistances when they crossed over both at the same time in an economy of effort. However, this obviously underestimated the power of this combined resistance at the time and of the overhead 2015 high at 187.40, and the move higher suffered a temporary setback. As I said last week, and I quote, "I do not think it may be long before we see further attempts higher, now that they," and that, by mean they, that is the green neckline and the dark blue upper channel line, "now that they are separating and their individual forces are a lot less than when they were combined," end of quote. I further added last week, and I quote, "You see, overall the bull channel is still the dominant pattern here, right now," end of quote. Well, this last bit does not seem that true right now, but I would say today the bull channel is an influence, a significant influence, as the market is running along the top side of the bull channel and occasionally dipping below it. Thus it is worth still paying attention to it. I would now just like to register a new resistance that does not impact the market today, but if things continue, may well do so. And that is the neckline of the April to May 2022 reverse head and shoulders pattern, which is highlighted in bright red on my daily chart, currently at 204.55. It is coming down at a shallow angle and will interfere with the combined resistance, seemingly significant resistance, of the November 2014 high at 201.35 and the interesting 50% Fibonacci line of the February 2014 to January 2023 move at 201.70 by late February next year, if not sooner. Now, I'm not saying we will see prices up there, but I am saying that if we do manage to get up there, this neckline could be crucial. So watch it carefully for now. London coffee futures. The influential pattern here from the middle of the year until really this month was the June to December bear channel. Attempts to break up and out of the pattern happened as far back as late October, but the real push higher happened in mid-November, with the market utilizing, to varying degrees, the rising short medium moving average currently at 24.60, the long moving average currently 24.55, and especially the medium moving average currently 24.57. In the process of breaking higher, the market also formed a small, late October to date ascending triangle, highlighted in dark blue on my daily chart. At the start of last week, the market broke up and out of this pattern, somewhat violently. In the process, prices jumped up and reached primary target for this break higher at 27.91, but by Thursday last week. However, the secondary target X2, the harder to reach target, is still live up there at 28.78, though we have just about managed it as well. Then there is the second larger pattern, the original broken bear channel in green. Last week I laid out some targets topside for a break of this pattern. I quote, Thus, we have a primary target X in the 2688 area and a secondary harder to reach target X1 in the 2838 area. The immediate overhead resistance of such a move towards target X are the June 2011 high at 2641 and the March 2011 high at 2672. Whilst for the harder to reach target X1, we have the limited March 2008 high at 2704 and the 2023 high at 2797. End of quote. Well, the move up reached the primary target X on Tuesday last week and a secondary target X1 by last Friday, in the process making a new all-time high. Today, we have seen prices dip for the moment. Yeah, they have actually, haven't they? But for the most part, staying above the June high and below last Friday's high. I will reserve judgment as to whether this is currently a topping action or not until I see some more market action. So for the moment, I'll be satisfied with target X2 above in fresh territory, and that's 2878. However, when I do look higher, I can see a projected 50% Fibonacci line up at 3083, which may be a little too rich for some in the market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.